Welcome, everybody, to the Double Shot, your favourite podcast with your favourite cousins. I'm James Fitzgerald, just one cousin here today, but it is a very, very exciting day because we have making his debut in front of the screen.
The champ is here! The champ is here! The champ is
And you'll be
here!
able to tell, he probably needs no introduction. He's introduced himself there. Producer Nick joining us for the first time. Welcome, Nico.
Good to be officially invited and not just bum rushing the mic halfway through an episode.
Yes. Yeah, no, we only saved that treatment for Mitch, Nico. So, you got the call up this morning. A little bit sus on it. It was the Melbourne Cup yesterday, which we had a great celebration in the office. I'm not sure if we had the office sweeps running. Do you get a winner or?
No, it was a big bets on the $2 sweeps. Closest I got was my horse getting into sixth position for about 6 seconds before it knocked back out. So, that was my excitement during the race.
Yeah. I mean, that's the great thing about such a long race is that your horse is somewhere in the mix at some point.
Yeah.
Even if just for a fleeting moment. I managed to come out just ahead. I think I dumped about $20 across all the sweeps, and I think I came out with about 30. So all in all, a good day. It's always good when you come out ahead, don't you think?
Yeah, absolutely. And I didn't ask you this morning because it's just sort of, Mitch can't come today. It's after Melbourne Cup. Was there a reason given or was it just implied?
Reason given from Mitch was that he couldn't get down in time. So he tried to say to me he wasn't going to get down here till late. And I think he knew that I had some commitments tonight and that I wasn't going to like that. And so, I don't know, I'm sus on him because he was up at Noosa. We had the triathlon over the weekend. He and I had a celebratory beer on the Sunday, which was well earned. I headed off Monday morning. He stayed for Monday and a Melbourne Cup event yesterday on the Tuesday. I'm led to believe from some sources internally, some reliable sources, that he's had a pretty good day. So, who knows? Maybe he spent a few fun coupons throughout the day. Who knows?
Good on him. That's what it's there for.
Anyway, his loss is your win. And good to have you on board, Nico. So for those who are not aware, Nick runs our marketing at the group, been in this industry for more than 10 years, been with us for more than 5 years, and he's a property investor himself. What I think is really interesting is he has a slightly different strategy to me. So I think we're going to have an interesting discussion today. They're very similar, obviously, in the fundamentals, but slightly different in terms of the types of properties that you've got so far. And I think you'll have an interesting take, particularly on interest rates, rents, and some of the things that are going on at the moment. Let's talk rates, though. Mm-hmm. Straight off the bat, first Tuesday of every month, the Reserve Bank of Australia set the interest rates for Australians on their mortgages. And it coincided, as it always does, with the Melbourne Cup. Always does. The Melbourne Cup's the first Tuesday in November. Falls in with this. And look, it was a bit of a dampener to the Melbourne Cup itself because you had interest rates go up to 2.85% from their previous 2.6%. Nico, first reaction from you?
Oh, another one? It's not great, but, we have this many in a row. I think you kind of get jaded. I think the first three certainly felt like they hurt a lot more than the more recent ones. Just, typical. Another month, another rate rise. Well,
yeah. It's a sad state of affairs when your first reaction is at least it was only 0.25%.
Yeah, exactly. Could have been worse.
But look, rates aren't that high. We've talked about it in the past. The 10-year average of the Reserve Bank interest rate is about 2.5%. Homeowners will pay about 2% on top of that. On their mortgage, 3% for an investment property. So 10-year average, 2.5%. We're at 2.85% today. We're only just above that 10-year average, still well under the 20-year average of 3.35. But it feels significant because it's happened so quickly. We've gone from 0.1% to 2.8%, 2.85%. Since May, Nico, can you believe?
Yeah, I think back to my first property 7 years ago now. I think the rate we started with was 4.35. So today we're probably, 0.5% above that. But certainly when you're low threes, high twos for the last little bit, and, even some people who might have had the mortgage freeze for the first year of COVID to then be back to higher rates or, the normal when we've had it so good for such a period of time, I think it's just that.
I can relate to that. I bought my first investment property when I was in 2011. So that's 11 years ago now. And the interest rate at the time was about high 6%. And I think it got up to maybe 7% at one point. And then I think I had a decade of gradual falls, albeit, 0.5% here, 0.25 here. It just gradually fell over time. So it feels a bit like Back to the Future for me at the moment. Tell me, though, we talked about before we started here what your main takeaway was, and you and I had two different main takeaways. So, talk to me through what was your main takeaway from the Reserve Bank announcement yesterday?
I suppose the comments around inflation, talking about what the rate's been year to date up until September, 7.3%. Expecting to peak around 8% later this year, then expecting to decline early next year, and forecasting, might see some rate drops. Sort of starts to come back down. The comments around the lag of having the impact and having it actually flow through to back the economy.
Well, they seem to be suggesting, don't they, that the inflation rate will peak at 8% and then drop in the first half of next year to be about 4 and a bit percent over 2023, and then a little over 3% over 2024. Now, I guess we're cautious looking at the Reserve Bank's forecast, given they told us that interest rates would be low for 2020 until 2024 at the earliest, was the words they used. But it is an encouraging sign, and it does sort of seem to mirror what we are seeing around the world at the moment, where it seems like we might be at the top of the crest, doesn't it?
Yep. John was talking about that recently in terms of energy prices going down in Europe, things like that. A couple of indicators seem like we're at the start of the turn.
Yeah. So, and you touched on my main takeaway, which was that the Reserve Bank Governor Phil Lowe talked about the fact that we've increased rates pretty sharply since May, and he said that we're aware that there is a lag between when we increase the rates and when it's passed on. And what I think he's alluding to there is a lot of people are on fixed rates. So a lot of these increases to interest rates today actually aren't hitting people. It's only hitting those who are on variable rates, which at most would be 2/3 of all homeowners today. So what he did go on to say is that high rates and higher inflation are putting pressure on many households, and they're aware of it. It suggested to me that he thinks as people come off their fixed rates, we'll start to see a significant impact felt, and that lag effect might see us actually go up in interest rates and then come back down, which is fairly well in line with the Commonwealth Bank's economist, who tends to think we're going to go high and then maybe settle in that 2 to 2.5% range in the early parts of 2023, which, for me, that's just normal. It'd just be nice to see the end of the increases, I think.
Yeah. No, they're probably more the worry around it. I think it's more the noise than sort of the numbers. You think how many people might have, held their repayments at the same rate from what it was a couple of years ago. For them, they wouldn't have made or seen any difference to their repayments. Therefore, their behaviours, their habits, their spending is not going to change.
And one last thing, he did cite on spending habits, the retail numbers that came out this week, and retail spending was up 0.6% for the month, which was actually a really good number because they've been up about 18%. So it has been going at 1.5% per month, but we've been spending a little bit less, down to 0.6%. So now about 7% in line with inflation. So it looks like retail spending starting to be affected too. So the Christmas spending data is going to be more interesting than it normally is when it comes to having an impact on rates, isn't it?
Yeah. Well, I think it's even sort of crazy. We're 7 rate increases now and the retail spending is still increasing. Like it's clearly not been enough for people to stop spending less compared to the previous month. And especially as we go into Christmas, the most expensive period of the year, I think it's probably more the, change of habits we might see in January, February once people realise, oh no, expenses are going up. We've had the big splurge over Chrissy. Now we're going to finally actually tighten things up. Yeah,
I think you're right. I think we're starting to hit the crest there. Now, we can't do anything about rates. And look, this is a bit of a normal. So I think it's a good thing for people to get used to, that rates are going to be about that 2.5% over the medium term. So I think you should get used to paying somewhere around 5% on your investment properties, maybe 4 to 5% on your own home. We can't do anything about what rates do, unfortunately. As investors, it's a risk that you just have to manage. You can't avoid the risk of, say, interest rates going up. What you can do, though, is manage that risk. And, maybe I'll question without notice, Nico, what do you think are the ways that people can take their own sort of destiny into their own hands when it comes to trying to minimise their risk and exposure to interest rates going up?
Just in terms of the loan structure, and I mentioned Alex has spoken about it recently in terms of checking your rates, getting your properties revalued in terms of dropping the LVR and sort of minimising your interest rate that way. Being on top of your rents. I think particularly at the moment, maybe not going for 12-month leases because you might sort of be cutting yourself out of a rental increase in the back half of it. So being right on top of that, telling you a story just before we started, we're in the process of releasing our property. I did the numbers, had a look at the rentals in the market. We elected to incorporate the bills because we were doing that separately. So between the bills being incorporated, then the market movement, it was going to go up by $150 a week. The property managers came back.
And what's that as a percentage? $150 a week?
That would have been that portion of the property, that would have been 25% increase.
Oh, in a year. Jeez.
Yeah. Property manager then came back and gone, Nick, I actually reckon you're $20 under market.
There you go.
And based on that. So, that's one thing in terms of, managing your cash flow, using tax variation, particularly if you have to pay a little bit out of pocket throughout the year, if the rate increases or, personal circumstances change and budget is a little bit tighter, you might not be able to wait sort of to the end of the year to get that lump sum coming back. So getting your tax variation set up, having that extra income, in your pay packet each week.
Yeah, so that's a very good point. And I think, that's something that I started doing. When I first got investment properties, I set it up with a tax variation to make it a bit easier on myself. And I haven't had it for a while because I find that, throughout the year, the property will cost you something to hold when rates are up. So let's say a property costs you $200 a week or so to hold throughout the year. But you will get half of that back at tax time at least, plus some depreciation. So you end up with probably at least a $10,000 tax refund at the end of the year. So it's sort of like forced savings. So it probably doesn't end up costing you money, albeit you've got to wait till the end of the year to get it. So what you can do as an alternative is I'll use $100,000 income, for example. So if you earn $100,000 a year, you're going to gross before tax about $1,900 a week, right? You got to pay tax though, so that would be just under $1,500 a week that you'd pay in tax. Whereas what you can do is by putting in a tax variation, your accountant does a letter for you to the tax department, says, look, Nick is going to get a tax refund at the end of the year. It's going to be about this amount. So rather than him waiting till the end of the year, I'm going to give you this letter which gives his employer permission to pay less tax to the tax department throughout the year so that Nick gets more in his after-tax pay from his employer. So instead of getting $1,500 a week, you'd get, call it $1,700 a week. Have I done a good job of that, Nico? It's always hard explaining numbers over a podcast. But the idea is you've got an extra $200 a week in your pocket throughout the year instead of having to wait till the end of the tax year to get it.
Yep. So in almost similar, like you're pretty much doing your tax return early. You're forecasting what you think it's going to be for the year and therefore tax me what that's going to be. And, again, we'll reconcile at the end of the year. What if rates go up during that? I've set it up at the start of the year. We do the tax variation and then rates keep going up throughout the year.
Well, you're going to get a double bonus because not only are you going to have that extra $200 a week in your pocket, but you'll get an even bigger tax refund at the end of the year. Having said that, though, you've got the same risk if rates go down where your employer might have paid you a bit too much. So,
or if you stick your rent up $150 a week halfway through.
Yeah, so correct. So you might have to be careful, Nico. But look, I think the starting point is get yourself a good accountant who owns property. That to me is worth its weight in gold at times like this. They'll know exactly what to do and how best to set it up and be conservative. And I guess one other way, Nick, is, and this is something I will defer to you on, because people that might be still looking to grow their portfolio, if you have a particularly sensitive around your cash flow today, you might have things going on in life or you might not be sure about your income, one way that you could de-risk your exposure would be to buy what we call a dual income property. And I know you've got one, so maybe you can talk us through, the dual income property and the pros and cons, if you like, when it comes to that type of property from a cash flow point of view.
Yep. Yeah, so 2 years ago now, we owned a unit that was originally first home, first property, lived there 5-6 years, and then wanted, what's the next sort of move. So we were looking at dual income properties. Part of the reason was, we wanted to move out of the unit, but we didn't want to rent. So we wanted somewhere a little bit bigger. So from sort of step one, we're already breaking the cardinal rule of, not mixing investment and personal. But, we're looking for something that we could live in. We'd be happy for at least sort of a year or two that would also generate us an extra income coming in. So it started 2020, and I say very start of 2020 before, everything started to kick off. Found a property. It's great. It was a 3-story triple occupancy property. So there's a 1-bedroom unit on the ground floor. There's a 4-bedroom unit in the middle, and then there's another 1-bedroom studio at the top. So we moved into the middle with some friends, rented out the bottom floor, rented out the top floor. Basically, all rented out when we bought it from day dot. Basically meant that it paid for itself, paid for its expenses, and still paid us another $400 a week. The main reason, I suppose, we lived in it to start with was, minimising the stamp duty that we're paying, and then at the same time, we'll, if we were to sell it, which being that it's so positive cash flow, I don't really see a scenario where we would ever want to sell it. Especially being the first thing you learn here, never sell. There's probably not going to be a capital gains implication, but that was part of the reason of living in it for that first year too, was, any growth in that first year we wouldn't have to pay capital gains on.
Lower stamp duty too, I imagine.
And the lower stamp duty getting in there as well, yeah.
And now you've moved into a different house when you started your family. It's now rented out. So I'd imagine the benefit there is you've got a really strong rental yield, which would, even at a high interest rate, probably still leave you some positive cash flow. That's the main benefit, isn't it?
Yeah, and that to talk about sort of de-risking, we decided to start a family. We just bought that property, only just maybe 12 months prior. And the same sort of conversation of, we're probably not going to be able to live here with a screaming baby, tenants upstairs, tenants downstairs. Not going to be good for us, not going to be good for them. But at the same time, don't want to go and rent. And even at the time, working on slightly higher interest rates, it was still about $100 a week cheaper to go and buy something than it was to rent. So that was part of me trying to go, hey, how can we control our expenses? How can we actually reduce some stress? And, probably do the counter thing of, we'll reduce some stress by going and buying another property. But what that meant was after we bought that property, moved into it and rented out the prior one, the Labrador property now, the triple occupancy, fully pays for itself and fully pays for our own home.
There you go. So look, that's another way you can de-risk it. Now on the counter side, you have to have council approval for those sorts of things, don't you? So, buyer beware, you got to do your research going in.
And this was also prior to the recent change around granny flats. So there was another thing where basically no property managers would touch it. So for the first 2 years, we had to self-manage it at the same time, which comes with all sorts of other, the savings of that property management expense, the cost of time and sanity.
There you go, listeners. So a few tips there, little tip bits. If you've got any other questions about that, feel free to let us know. We went through a fair bit there in a little bit. The main point being is rates, you can't control them. What you can do, though, is manage the risk. All right, producer Nick has come up with a little gem just as we had a break there. So I'm going to throw it back to you there, Nico, because that one should have been televised on the pod. Talk us through another little tax hack that you've got, particularly for some of our younger listeners out there.
Yeah, so a bit of way to force yourself savings, just something you can set up and, you won't have a choice. And it's almost like a reverse tax variation. So if a tax variation, setting it up at the start of the year that, what I'm going to get back at the end, I just want to tell you ahead of time so I don't have to pay it throughout the year. This is doing the opposite where, you can go to your employer and everyone might remember filling out with your employer and there's a little, do you want to claim the tax-free threshold? And you can change it even after you've started work. Just go to payroll and say, I want to stop claiming that tax-free threshold. So for those who might not know, the first $18,000 of income you earn, you don't pay tax on it. But if you tell your payroll to ignore that, they'll charge the tax throughout the year on that amount. For me, I think it's about $5 or $6 grand a year that it works out to. So call it, $100 a week extra coming out of your pay packet. Sits over at the ATO all year, but then that's a guaranteed $5 or $6 grand before any deductions that you're going to get back at the end of the year. So that's what I did for the first sort of 5 years of career, just forced myself to lock away that money. The last 2 years, I delayed doing my tax return, so that way I couldn't even be tempted to spend a lump sum once it came through. And that's then what we used to use as a deposit for the first property.
Fast earning a nickname for yourself here, Nico. Nick Cash Stevens.
Yeah, cash is king.
Yeah. I'd like to see your mattress. It must sit pretty high. Hey, very good. Two great hacks. In fact, I think we've had 3 or 4. It's been a hack pod so far. A few hacks for people. Hey, I want to talk about house prices because that came out early this week too. But before I do, and whilst we get the notes up, do you have Twitter?
No.
Neither do I. But I found it very, very interesting for the past, I don't know. It feels like 6 months. The 6 months that's played out where Elon Musk, the owner of SpaceX and Tesla, has mounted a campaign to buy Twitter and successfully achieved that by becoming the owner. I think it was on Thursday last week, and it's been bizarre. I don't know if have you caught any of it?
I've caught bits of it. Yeah, he's now the new sole director, trying to take it off the public market. I think we all saw the great video he did of him with the kitchen sink in the lobby. So let that sink in, and then I think it was pretty much day one, like as it's all happened, he's immediately fired all the top executive board. Yeah,
and particularly he's been big on censorship. So he's all about free speech and and reducing the amount of bots, reducing the amount of hate speech on Twitter. So they're great ideals. You just can't happen to have a little bit of hesitation around the guy because he's probably the only person in the world who can single-handedly, with his own tweets and comments, move the needle on the value of assets, would you say?
Yeah, no, I've talked about that the other week. I think that's incredible when he can, buy a ton of Bitcoin, announce Tesla's going to start accepting it, the price goes nuts, what he's just bought's all gone up like mad, then, dump it and then stop accepting it and it all goes back down. So, when you can indirectly, manipulate it, make yourself, tens of millions over a couple of weeks just by a couple of tweets. Powerful guy.
Yeah. A little bit of nervousness, but either way, he's clearly a very successful and wealthy man because he's paid $64 billion to buy Twitter, the social media company there. Apparently has grand ideas to turn it into a WeChat where you can do payments over it, facilitate online shopping. So he's got some big and bold plans, some nice idealisms. They all sound good, but because of the nature of the man, you can't help but have just the slightest bit of hesitation in embracing it wholeheartedly.
It's a big. I think JP Morgan was a big chunk of that initial buyout cash, and I think he put himself in about $6 or $7 billion.
Okay, so there you go. Yeah, 6. Okay, still not a small amount. Either way, get the popcorn out. It might be interesting viewing over the next little bit. Okay, house prices. So the data came out. The headline was house prices down across the country by 8% in the month of October, which is the case, varying degrees of it. Most capital cities down by at least 0.5% in the likes of Adelaide and Perth, and then up to 2% in Brisbane. It's interesting, though, because if you look under the hood, what it tells is a really interesting story, almost of two different speeds, I would say, in the housing market, doesn't it?
Yeah. Yeah, it's mad. You look at some areas that are still gone up by 10, 15, 20% throughout the year, while you've got others, basically done the same with the negative side in front.
Correct. And those areas that you're talking about, which are still going up, albeit, they're slowly plodding along, are the outer, more affordable markets. So places like Springfield in Ipswich, parts of Logan, and, if we talk about Brisbane, in Melbourne, it's the southeast, Cardinia, Casey, Wyndham, Melton, those sort of outer fringes. And then in Sydney, it's your Camden, your Perths, Liverpool, the Blue Mountains, Mount Druitt. It's those outer fringe areas that are actually defying the odds. So at one end, you've got those markets still bubbling along, holding their value, maybe going up by 0.5 to 1% a month. But then at the other end, you've got the high end. So call it the top 25% by value. And what we're seeing there is they're going down by the 3 or 4% a month in some of the really expensive areas at the moment, which I guess makes sense to me because the top end of the market, the top 25%, was the first to go. and it went up by 60, 70, maybe even in some areas 80%. So it's now coming back sort of 10 to 20%, whereas those more affordable areas that have kept going, they had more modest growth in that period, maybe 30, 40%. So still, good growth, but not this significant sort of almost, stratospheric growth that we saw in the top end of town.
Yep, not much more to say than that.
Yeah, so look, you just got to look under the hood there, guys. I think the takeaway for me is, look, if you've got top-end property, you've probably bought well, you've probably made a lot of money. It's going to come back a little bit. It's just normalising. If you're in the affordable end, those workhorses, they're just plodding along. I still think there's good opportunities out there. You just got to take a long-term view. That's always got to be the case with property. Don't get too bogged down on the month-to-month, day-to-day movements. Take the long-term view, protect the cash flow like we talked about earlier in the podcast, but keep the eyes a bit further in the distance than just one or 2 months' time.
All right, James, you're telling me, government's got together, they're solving all the world's issues, some new housing accord. What's it all about?
Yeah, 1 million houses in 5 years. That was the headline, and it was everywhere. I think it got to every paper and news outlet in Australia last Thursday when the announcement came out. It's a lot of houses, but it is a lot of houses, but it's not. And what I mean by that is it's 200,000 houses a year that the government's come out and said, we're going to build 200,000 houses a year to solve the housing crisis that we've got at the moment where we just don't have enough houses. The problem is we've built 200,000 houses a year for the past 5 years. So we're not going to build any more houses than we have been for the past 5 years. And with international borders opening, the issues and challenges around, rates and people's ability to borrow money, it's sort of bizarre because at the same time, you've got the government saying that they're thinking we're on track to build only 180,000 houses in 2022 and 2023. And from there, they're forecasting 160,000 at best because of the issues getting supply out there and for people to borrow money. So that's about a $60,000 shortfall by my calculations.
Yeah, not good. And as I asked you before, they said they're going to do this. Well, how? And your comment was, they're going to slash a bit of red tape, or they're saying they're going to slash a bit of red tape, but how, what, and what they sort of look like, I guess yet to be discovered. But yeah, not good, especially for tenants out there, people trying to get into the market. We talked about my scenario, but rents, year on year is up 10% for the year. Doesn't seem like there's any reason to expect that it's going to slow down. Sydney still up 8.7% for the year. Melbourne up 6% for the year. Brisbane up just under 14% for the year.
14%'s a lot.
That's ridiculous.
That's a lot. That's hard to wear as a tenant, isn't it?
Yeah. It's a big increase. And then again, for the landlords on the other side, what's the relative mortgage cost gone up by? Probably similar, if not a little bit more. Perth up 9.8%, Canberra up 5.7%. So, ever up more than 5% for the year, most up around that 10% average.
Yeah, exactly. And look, to your point, what are they going to do? It's a challenging one because there's 3 levels of government, so they probably can't go any further at this point than saying that we're going to set out to achieve this. The how is probably the hard bit. I don't have the answer, but it seems at this stage that there's not any clear sort of idea how they'd unlock it. Nothing like, say, what we talked about in last week's podcast where places like Vancouver are saying unlimited height around train stations within 3 or 4 Ks. There's nothing sort of to that magnitude just yet, but look, I guess having the intention is a starting point, isn't it?
Yeah. Well, hopefully a bit more solution on the supply side and not just, incentives to get more people into the market we're struggling to supply.
That's that. Well, hopefully. And Nico, I think we run out of time, the allocated time slot here. Give us some feedback. What was it like? Did you enjoy it?
Certainly went a lot quicker than sitting on the side. I think there's certainly a lot less sound effects this week. No, it's great being in the chair.
We've got someone that helps. Jordan, our man Jordan, might be a little bit busy, maybe transposing some afterwards.
Also. I
did want to now question without notice because I was not prepared for the stat fact this week. Do you happen to have one?
Do I have a stat fact?
Stat fact.
The stat man.
Stat fact.
Maybe on the back of the Twitter sort of stuff. So obviously, like Twitter just doesn't really have anywhere near as much of a presence in Australia. I think Twitter's maybe the third, maybe fourth, if you count Facebook Messenger as a separate platform for the main Facebook or Meta platform around the world. Twitter, I think, doesn't even really rank on the Australian, top use sites. I think it's maybe like 7th or 8th, which when you look at like the, 5 million, 6 million users, by the time you're getting down to the 7th or 8th, like they're fractions compared to, the top 3. So
where is it big?
Twitter, I think it seemed like US seemed mostly pretty big. In Europe, for whatever reason, we just haven't tapped on Twitter as much in Australia. And I don't think, we really get any advertising. I don't think it's a focus of them for some reason.
Well, there you go. That is an interesting stuff. I'll pay that. That I did not know. I just assumed everyone was on Twitter and I was in the minority, but maybe I'm not. All right. Hey, great to have you, Nico. You're going to stick around for the quick shots. And hopefully, I'll tell you what, Mitch might be in trouble if he ever, if we ever are out of someone like to fill the shoes for Alex. You might be the first cab off the rank above Mitch these days.
Pipped his spot in the reserves.
All right, guys. Take care. Enjoy. Have a great week. And hit us up with any questions if you got them for the quick shots later in the week.
Thanks for listening to another episode of The Double Shot with your favourite cousins, Alex and James Fitzgerald. If you've got a burning question or something we absolutely need to talk about on the pod, please write to us. Both of our emails are in the show notes. For little real estate tidbits and a little bit of banter, a lot of banter, you can follow us on the gram. Our handle is thedoubleshot.podcast. That, my friends, is thedoubleshot.podcast. Until next time, think of us when you sit back and sip your next double shot.